Is the Australian market actually crash-proof? No market is bulletproof, of course. There are various fluctuations. They go up and they go down.
Property prices can fall, and they are falling in many areas, and some areas can fall sharply. Doesn't behave like the share market with the same level of volatility. And I think it's important today to unpack also that there is no single Australian property market. You can look at the share market as a single market, but when it comes to property, it's very different. Let's start with looking at why the property market is different to the stock market and why property is less prone to these sort of instant, broad-based panic selling events that you do from time to time see in the share market.
Yeah, so shares, Simon, highly liquid.
Yeah, that's right. They get priced minute by minute or almost millisecond by millisecond, whereas property is very transaction by transaction. Those transactions are slower. And they're more expensive. There's all of your entry and exit costs, your stamp duties on the way in, your selling costs on the way out. And there's a lot more emotion involved in these transactions, particularly for an owner-occupier selling their own home.
A third of the market is owner-occupiers that have properties owned outright. A third of the market is owner-occupiers with mortgages, and a third of the market is renters, tenants. Owner-occupiers with a mortgage obviously feel any interest rate rises. And owner-occupiers with no mortgage are, yeah, cool, whatever. It affects my savings. They want interest rates to go up because that way I'm going to earn more if I've got cash in the bank, let's say. So the part of the market that tends to dominate the median price movement is those that have mortgages. And speaking to the emotional side of this, for an owner-occupier to move home, they have to pack up their lives. They have to clean their cupboards, put stuff in boxes. They have to then figure out where they're going to buy. There is a whole hurt that they need to face. But if you sell a share, it's instantaneous. It's immediate.
That's right. I mean, the share market is almost entirely investor-driven. Compared to that, 2/3 of the property market is owner-occupiers, either owning outright or with a mortgage. And that's a key difference here in terms of why these markets behave differently. With that residential property market, the vast majority living in their homes, people don't live in their shares, right? But people do live in their homes, and there's that sense of disruption, that inertia, if you like, that you mentioned, Brendan, in when it comes to a decision to sell a home that you live in, whether you own it outright or have a mortgage on it. And that changes the dynamics here, I think. Most property owners aren't therefore trading assets. Yeah, there's that 1/3 that is occupied by renters and therefore owned by investors. But the majority of property owners are not trading assets. They're living in them, and they won't sell just because a price index falls, unlike the share market where people might panic sell because they see values going down.
Owner-occupiers that are debt-free and living in their place are therefore unlikely to move. And any interest rate variations don't affect their ability to survive in that house. So there's a massive inertia. The owner-occupiers that are mortgage holders, different story. They feel the interest rate, they feel the economic change and challenges. In this country, we have recourse lending. If we're in a negative equity scenario, meaning prices come down, let's say, and they come down far enough that I'm in a negative equity position and I sell, that negative equity follows me wherever I go. So there is a massive resistance to face the financial loss of that component, which is mine.
Exactly. And very different to the experiences in some parts of the world, like during the GFC in the US. There were large numbers of properties that were on essentially non-recourse lending. And the phrase jingle mail was born out of that, where those homeowners, when they felt, well, I can't keep up with my repayments, I'm just going to bail out of this house, just dropped the keys in an envelope and mailed it back to their lender, handing back the property with no real further consequence to them. As you say, Brendan, that's very, very different in Australia, where you still owe that money and you're still liable for it if you don't pay back the bank. So there is that much higher resistance to simple cut and run, let alone the fact that we have some much stronger lending standards in this country than many parts of the world, and certainly even stronger since the GFC. in terms of building in things like servicing buffers and their whole responsible lending side of things as well, which provides protections around all of that too. To have a dramatic impact on the market, you would need something like a sudden and really significant unemployment shock. So unemployment jumping from where we are in the 4% range up to like 8% in a very short space of time, to find people that severely impacted that they would simply have to throw their homes out. Those homeowners won't sell their homes just because there's a dip in the market or prices have softened, or even if they find themselves, as you say, Brendan, in a negative equity position, they will fight to keep the home. And that tends to be what happens in Australia. And the fact that we have this responsible lending environment here, and you have servicing buffers that are testing your ability to afford repayments at 3% higher than the interest rate you're actually paying, that provides a shock resistance, if you like, as well. So you really need a combination to see significant across-the-board price falls. You really need a combination of weaker demand, forced sellers because of things like rising unemployment, tighter credit where people just can't get lending, and significant rising stock levels. So more and more properties listed on the market, so that the sellers are really having to compete hard against each other and they're chasing the market down, along with falling confidence. Now, we certainly have some elements of that at the moment. Confidence is hardly at its highest level right now, and that's translating into things like weaker demand. But you don't have the forced sellers scenario right now. You don't have skyrocketing unemployment. And even putting that aside, that's talking about the market as if it's one property market. But really, and I think this is critically important to understand here, it's not one property market, is it, Brendan?
No, absolutely not. There are 15,000 suburbs in this country. 5,000 have units. Housing markets and unit markets are very, very different. And areas play out differently. Infrastructure plays out differently in those areas. The dynamics of age group in those populations make changes or differences. The percentage of owner-occupiers, debt-free, owner-occupiers with a mortgage, and renters within those suburbs have an impact. So again, while nationally there's a third, within a suburb it varies greatly, and that has an impact on price and sustainability. We've been talking about the volatility of median prices of house prices, which is the basic essence of this conversation. The volatility is limited because of, as we've been saying, the cost to get in and out. The volatility is limited because of the lifestyle and the lifestyle impact. The volatility is limited because of the reliability of income coming in, et cetera, in most circumstances. And right now we've got, as you're saying, Simon, strong employment numbers. So people's risk to their jobs is not that high. People typically, as a concept, before I get into the individual suburb stuff, people typically will fluctuate their food intake more than their housing position. People will in good times buy the Wagyu beef and enjoy a good meal, and in the tough times live off baked beans. They will fluctuate their food, their dietary requirements to accommodate any variability in income and volatility in income, rather than their housing, because the inertia is so great. And with a greater percentage of owner-occupiers in a suburb, so now we're getting the suburb data level, if you've got large owner-occupiers debt-free volumes, large volumes of mortgage, very small volumes of investor, you've got an incredibly stable suburb. Why? Because of that inertia. You don't get huge volatility in median prices at that suburb. However, there are suburbs for which 70, 80% is tenanted. Now, if you've got investors that are hit by, policy change, a budget that turns around and says, you know what, this whole negative gearing thing, we're going to change that, shake that up a bit for sport and entertainment. If that's the case, then you've got a scenario where those suburbs particularly are significantly impacted and significantly more volatile median price movement as a result. Unit markets, housing markets are very, very different. Unit markets typically have a greater percentage share of renters as opposed to, and yields as opposed to houses. And if you get a large percentage of units with rentals, then you've got, again, similar volatilities as a conversation with houses. I'm going to share screen if I can for a bit, just to highlight some suburbs that I just had a very quick look at to illustrate some volatility. So this is North Kellyville. The site is propertyvalue.com.au. This is North Kellyville, median prices in North Kellyville. North Kellyville, as houses, started to back off at around June 2026 and has been a steady decline. If we have a look at Homebush a little more volatile in its median prices, I get it, but as a broader trend, started to come back in October. Now, they're not neighbouring suburbs, they're different suburbs, but as an indicator, no two suburbs behave the same way at the same time. Elizabeth Bay units has just gone up. So you're going, hang on a minute, the whole market's shifting. How can Elizabeth Bay, which is a fairly expensive area, be going up? I mean, units themselves are $1 million each. How can they be? They're going up. Dawes Point, on the flip side, has been coming down since August last year and has recently just hit a significant low. No two suburbs behave the same way at the same time. And in fact, another breakdown from the Totality monthly chart pack just came out. This is the latest data on price point variations. Those suburbs that are the most expensive are all performing the worst right now around the country, except for Darwin. Go figure. So when we speak about a market, the property market, you have price point variations, suburb variations, unit housing variation. It is never one market. And to that end, then, you go back to, what do we need to look for? What do we need to find and see so that we can get an understanding? And that requires us to drill down. So what are some of the dynamics, Simon, that we really need to look at?
We want to understand what makes a market, and we're talking about down at the individual suburb level here, what makes a market more resilient or more vulnerable? Because if we can understand that, we can make more informed decisions about where and how we invest, yeah? So
absolutely.
Let's look at some of the key elements that will increase the resilience of a localized market. And as we often talk about, property is all about the balance of supply and demand. It's just like any other part of economics. Unfortunately, most commentators still don't seem to get that. But really, if you've got an issue where you've got very tight supply and sustained or increasing demand, that's going to provide support for prices, obviously. Basic economics 101. So we look for tight supply. We're talking about the number of properties available for sale currently and in the immediate future. So we're looking at the number of listings on sites like realestate.com.au, Domain, and so on. What's actually available to buy in an area? How tight is that supply?
As a heads up, low listings might be 1, 2, 3, 4, 5 listings. But if you've only got 100 houses in a suburb, 5 listings is a lot. So if you've got 1,000 houses in a suburb, 5 listings is really tight. So you've got to have a comparison to the size of the suburb you're referring to as an indicator of what low actually is.
Absolutely. And it's a relative metric, because on the flip side to that, you're looking for strong demand or stronger demand, sustained demand. So you're looking at the number of properties that are actually being purchased over the recent period of time and comparing that to what's available. And if you've got a disconnect, if you've got far more being purchased than are currently available for sale, then that's going to provide some of that resilience. We look on the rental side as well. Do you have low vacancies? Like, particularly if you're an investor looking to hold a property, you'll be looking for some support with the cash flows of that, presumably. So you need to understand whether you've got low vacancies. Now, what is low vacancy in rental terms? Well, the national average over the long term, I think, Brendan, is something like around about 3% vacancy rates. But we've had consistently below that in a lot of parts of the country for a number of years now. A lot of areas do have a fairly tight rental market, but not everywhere. So you have to look at what the local situation is. How many properties are actually available for rent?
National at the moment, we're under 1.5. It's half that. So incredibly tight. Although that said, you're also getting a change in the nature of the market. There are more room shares, more rooming houses available while there's less stock. So there's some dynamic changes that are occurring in the rental market. But the upshot is, broadly, there are low vacancies and they're still really tight now. But as you say, Simon, not everywhere.
Then you look at who's driving the local market. Is it an owner-occupier dominated market versus an investor-dominated market? If we've got the vast majority of properties owned by owner-occupiers, say ballpark 2/3 being the national average or more, then that's going to provide that additional resilience, that additional stability. especially if when you look beyond that, you can see strong household incomes, you can see relatively low unemployment in the local area, and access to things that create that owner-occupier appeal, like good infrastructure, schools, other amenities, that kind of stuff. The other aspect I'd be looking for is thinking forwards. What's in the construction pipeline or likely to be in the construction pipeline moving forwards? Could you have a lot of additional new supply suddenly flooding into the market in the coming months or years? Or is it already largely established, infilled already to a certain degree, no greenfields estates opening up, nothing like that, in which case it's going to restrict that incoming supply as well. All those things combined help make a suburb more resilient and less likely to experience that kind of sharp crash, that volatility.
And backing you up, if this suburb's got easy access to service, amenities, transport, you've got a comfortable existence, look at the age group within it. If the age group is mature, they've got teenage kids, they're unlikely to change anytime soon. If they've got good schools and attractive for primary schools, once you establish a kid in a primary school, the odds are you don't move so much. You got them in a high school, particularly in the later high school years. You don't want to move and disrupt their education. There's a stability there that exists. And that makes a difference to median price movements. And that's what this is all about. Median price movement is the measure of volatility. If you've got median prices that are fluctuating down, then you go, oh, crash, up, boom, boom. But if you've got stability, you've got a scenario where you've got a steady increase or plateau, or even if it's a decline, it's nominal. It's not that significant an issue. So the concept of we're going along fine cliff edge doesn't exist in the property market, and particularly in these more resilient suburbs.
Let's look at what would make you actually more vulnerable, or a suburb more vulnerable and more at risk of tipping over a cliff like that. What could actually trigger that? Well, it's really the opposites of what we just talked about. If you have oversupply, if you have far more properties available for sale than the evident demand for those properties, then you're in trouble in terms of price growth. Prices are far more likely to decline in the near term. High vacancies could be a leading or early warning indicator as well, because if you're not even attracting tenants into the area and you've then also got an oversupply of properties listed for sale, you've got an issue with demand fundamentally. And you're probably more prone to finding yourself in that sort of situation if you're in an investor-dominated suburb. So where 40%, 50%, 60% or more of the properties are actually more investor-owned, those investors are more reactive to things like price movements, more sensitive to that, and more readily able to throw their property into the market and dispose of it than an owner-occupier in the same area is. So the more investors you've got, the more potential there is for those investors to inject volatility into the price movements in that area through their reactions, their behaviors. Again, coming back to the opposites of what we just talked about, if you've got a lot of very generic new stock coming into an area, so it's a greenfields estate with 1,000 clone houses all under construction or new land releases every couple of months, you've got an ongoing issue potentially with supply that's likely to suppress or undermine prices. And that'd be something to watch out for in those areas too. And then there's the usual, I think, economic fundamentals of the area. Do you have lower, weaker incomes, higher rates of unemployment that mean that you don't have that same support for home ownership that you otherwise would? Or let's go back to the end of the mining investment boom and where some of those mining companies pulled out of regional towns where they'd otherwise have been renting properties, or they made the decision to build their own rental properties for their staff. If you've got that reliance on a single industry for employment, then obviously you're more vulnerable. If that something changes in that industry, that can flip the market in that suburb overnight. So we've got to be conscious about that due diligence on where we're investing.
You don't buy a headline. The encouragement is to read a market. If a headline comes out with drama, it's clickbait. Don't jump in just because it exists, and don't go panic because it exists either. The Australian market is not bulletproof, of course, but there are certain things that are going to have to be really dramatic for a crash to occur. But it takes a lot for that to occur, and the market that we're seeing right now is not leading to that. It's leading to a slow and more gentle decline for a period, and it's not across the board. There are suburbs that are still in growth. There are suburbs where it's a declining worst. So it's a matter of understanding what's happening locally on the ground. Don't panic because of a national headline. Don't assume all property is safe either. Drill down to the suburb level, the type of housing and the strategy that you want to take on within that environment. What is it that you're looking to do? If it's a buy and hold, great. Be mindful of what you're getting into. If it's an add value sell, great. Do the numbers to make sure there's profit in there. Pick the areas where there is a neutral market or even growth, despite the declining broad sentiment. There are ways to make money in the property market at any point.
Recognise that the Australian property market is not one market. It doesn't move as one uniform block. The smarter investors, when we hear a headline saying the market, we ask which market. And that's where we do our analysis. And that's how you both mitigate your risk and find opportunity today.
The question is not whether or not property is crash proof. It's whether or not your strategy that you're taking into your investing is market proof. If you're a new member of this community, welcome. It is a pleasure to have you join us. I hope you got something out of today's Property Pulse Fireside Chat. If you're finding value in what you're seeing here, tell your friends about it, share it. This stuff is there to be shared and used to support better decision making in your own property investing. Thanks for joining us. Chat to you next week. See you guys.
Thanks, everyone.